Hello traders, it's 8 a.m. Chicago time on Wednesday the 18th of April 2018. This is another Trader Bite. We prepare, we anticipate, we execute, we review the next day, on and on and on. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Looking at the market stance in this session in the Globex, U.S. indices are higher. The S&P is trading higher by about 9 points. And overall, it looks to me like we are continuing the trend up. Crude oil challenging its highs, up $1.29. Some commentary from Saudi Arabia, I believe, this morning, saying that they're anticipating. Saudi Arabia said that it favors oil prices at $80 or even $100. It says OPEC is unlikely to change oil production cut agreement at the June meeting, even if OECD 5-year oil inventory target is achieved. This is giving oil a nice little boost, and we appear to be moving along. So that's oil. Gold, interestingly, is also higher, $1,355 an ounce on the CME on June gold, up $5.70, up 0.42%. The laggard today is the bond, down 21 ticks, followed by the cable, down 51 pips. And the DAX is dragging as well, down 29 points or 0.23%. That's the lay of the land for today. What's on deck for today? We have the Bank of Canada rate decision at 10 Eastern, 9 Central, and we have the DOE inventories. As always, I strongly suggest you find a good calendar. If you want a recommendation, just tweet at me or go to convergenttrading.com/contact and drop us a note. We'll send you back a link. We also have the Beige Book release at 2 p.m. Eastern. We've got a couple of Fed speakers. One has already released remarks. We have one at 3:15 Eastern, 2:15 Central, and at the bit close at 4:15 Eastern, 3:15 Central. Okay, let's look at what we expected yesterday versus what we got. Again, 2 days in a row, we have our primary scenario playing out almost exactly as expected. Excuse me. Thought I muted the mic there. We have our exact scenario playing out just as expected. The market was opening at around 26.99 and a quarter, 26.98 half. Lots and lots and lots of trading occurring at that price. At 26.98 half yesterday, and the expectation is we would start to move lower in a balanced, choppy type of behavior, open auction out of range, and then eventually we would cross the gap zone we had up to 27.1250 and close and get rid of this gap zone here by getting to the other side, getting to the 27.13 stock zone. That's the primary scenario. I could go through the secondary and tertiary scenarios, but I don't see the point. Here's what actually happened, just for the sake of abbreviating the Trader Bite. There it is. Drift down. Decent delta on the down drift. And then we left a gap behind. There's the gap. Here's the new gap zone if you get the flex levels of the cloud notes or the cloud-based levels. And then we start to drift up. We get our push into the gap zone. We consolidate for a bit. Nice big fat zipper here. Took a couple hours. And then we finally get to the 27.1375 stock zone or 27.13 stock zone. The gap that was up here is gone, right? Just as anticipated. So overall, here's the thing though. even though scenario 1 played as planned, even though scenario 1 hit pretty much every level as planned, I didn't get a trade off. I actually didn't participate in this rally at all. It's not my kind of trade. Once I missed a turn here, I'm not keen to chase this on the way up. It's not my trade. So I did not execute on that plan at all, even though it was in place. So I didn't see any clear opportunities to get long. The next opportunity that came up for the long, the clear opportunity for the long occurred right here, that I attempted to lift and could not. And by the time I started to respond, it had already moved too far for me to justify the risk reward. The next anticipated support right at the IB high against the mid was not at my desk at that time. So overall, not a very productive day yesterday. Just some crude oil scalping. That's it. So that's how things played out yesterday. How did they play out on the overnight session? The overnight gave us basically 90% of the inventory. Over 90% of the inventory is long overnight. We're doing the flag, the pole, flag, and then push for another pole, flag down, pole, flag down. So overall, buyers are in control. Buyers are in control here in this overnight session. We have okay volume, 125,000 expected. We're at 156. The range is pretty good, 2701.50, 2718.50, 17 points of range. And we are right up against the big target mentioned last Thursday. I did mention, Wednesday or Thursday, I mentioned that 2720 is on deck for the next week or so. And here we are right at its doorstep at 1850 on the high, on the overnight high. So pay attention. Everything looks bullish to me. Overall, we'll look at the composite in a minute. Everything looks pretty much bullish to me. We're above the mid. We're above yesterday's point of control. We've breached the yesterday's high. We're above VWAP, and we are stair-stepping up. So all of it just looks like a short squeeze to me, as I'd warned last week. Just if you're short, pay attention. A quick look at the composite just to see, or like the British like to say, composite, just to see where we are and what we've accomplished. So this composite here starts since last August. Okay, so last August we had, through the summer, we had this consolidation. From May through August, we just traded sideways pretty much in a range of about 100 points over 3 months. It's terrible range. And then we just started to climb up and take off as the tax plan kicks in. And we pushed to 2880 on the high. This is adjusted for the June contract. And then we had our nice historic move down in February. And we've been trading in this February range. So we've been trading from the high to the low starting February 2nd in this micro composite. But I've drawn this composite to include all trading from the breakout of the consolidation occurring between May and August of last summer. And you can see here how we keep testing and responding above this point of control down here at 25.85 and a quarter, and then we finally push higher and through the 2700 yesterday and the day before. And so what we've got here is a market that's starting to move into this three-day composite right here, and this island of a top. By historic, I just mean the movement had hit some historical volatility or range metrics, not historical movement. by any means. We've seen much worse in 2008, but we haven't seen this kind of violence to the downside since '08, actually. But we're starting to make our way through and repairing these upper areas here. We're starting to drift up into those areas. We're leaving behind this nice, steady, balanced area that started out on the 22nd of March. That was a separate composite that I had going. I've stopped updating that composite. We're out of it, and we're starting to move our way through the next area up these 3 bars. So overall, this is an impulse pullback, higher low, and then looks corrective to me. To the upside. Does that mean we're going to be linear to the upside? It doesn't, but it could. Notice that range is falling pretty aggressively, right? So this pane here, this middle pane, is measuring the range, the high minus low, on a daily basis, and it's giving us our statistical histogram of those ranges. The mode right now, or the point of control of the daily range in the S&P going back to August of 2013 is 10 points. It's much higher if you bring that back to January, but it's falling back. We're starting to move towards that black line, this black line here, which represents the point of control, which is 10 points, or the mode. Statistically, that's called the mode. We're moving very quickly. We're compressing very quickly, and so is the volume. Just moving lower. This is taking into account rollover in March, but we're starting to do that. And this is likely to continue to feed. This is the result of, and will continue to feed this move up. So just caution if you are short and are holding a big short position. I don't believe it. I just don't see the evidence. I don't see evidence that you'll get much relief on your short. We're in a big triangle here. Okay. And we're starting to move to the other side. So we're clear pretty much to 2750 currently. And we have open roads ahead. We're moving back into the 2720 point of control for the February move. So this area here has a point of control that used to be 2720 up here, has shifted down, but we're about to shift it back up. So what does that all mean? It just means that this has got some room up, and you better get used to a grind up, just like we've seen through this nonsense back here. So it's just how we're setting up. Those are the facts. Okay. I want to remind everyone also that crude has rolled. If you're trading crude, if you're trading energy, speaking of crude earlier, if you're trading energies, crude has rolled into June 2018. So make sure you roll and make sure you refresh your data so that you've got the adjusted prices. Okay. What am I expecting today? The expectation for today is, again, we're on the edge of the prior day's profile. We're still in the stock zone. We did push to 1850 overnight. The point of control is at the overnight point of control is just above us at 2717 and a quarter. We moved so that we've moved a lot of volume to the top of the range. So there's a lot of fuel up there. My expectation this morning is that it's very likely to become responsive back into the prior day's range. I'm expecting it to push down into the 2708, 2709 area. This was pretty good resistance yesterday that we traded against for hours, and then I'm looking for an impulse back out, and I'm looking for 2720 at some point today as a key target. I'm going to keep my range expectations modest. So I'm looking for 12 or so points. That takes us from 2708 all the way up to 27.2050, and that's scenario number 1. Okay, there's nothing here that says that the market's weak at the moment. That could change by the time we open. I don't know, but that's how things are shaping up. Secondary, we have a small open test drive that pushes us into 27.20 again, consolidate in the 27.20 area, and then ultimately push up into the next stock zone up 27.26. If you recall, 27.27 was big on the way down. We traded this price quite a bit. I'm expecting a challenge there. These stock zones, I take them on the first test. If I'm not long, I'll take the short on the first test based on the order flow. So if I don't get anything long here, which is my preference, is to find a pullback for a long. Why a pullback? Why not just get long on the open? I need to define my risk, and I don't want to be hanging up high on a long with a market that has a fair amount of room to move lower, meaning 27.14 to 27.08 right now. That's too wide. And so I'm looking for the pullback. I'm looking also for the market to find its buyers before I step in, right? So if you were someone who was looking to buy something expensive, let's say a big house, wouldn't you be more confident if prices, if the price of the house is $1 million and the prices drop to 900,000, 800,000, 750, and then you saw through your neighborhood's comparables that now instead of 750,000 for the last sale, exact same house, now it's 775. Now you're stepping in with confidence, right? Now you know that there's potentially a bottom that's been put in, and there's a lot less risk to the downside. Well, traders think that way. Fund managers think that way. So buying on a pullback is always my preference because it's evidence. I see the evidence in the price, in the delta, that the bottom has been established, and that's what the market was doing on the way down. It's looking for a bottom. And so I'm always looking for that. Days where we don't get that, it just pushes right through, then I'm basically relegated to finding a pullback to a known area, mid, opening swing, a stock zone, things like that before I'm stepping in. I'm just not a breakout trader, okay? Just explaining my approach versus yours. I want to leave you with a thought now that you've got the scenarios. There's a lot of certainty out there for some reason. A lot of people are saying it should get to this. It should do that. It is going to do this. I cannot express how damaging that is to your ability to maintain an unemotional and even bias on your trading. If you find yourself talking with certainty about trading, take a break. It's probably time for you to get whacked. I'm just telling you that from 17, almost 18 years of trading experience and 24 traders that I've backed. Every time somebody's certain, they get whacked. So just make sure when you're talking about the market, you're talking about probabilities. And so there is no certainty in probabilities. And so you're starting to program, when you talk with certainty, you're starting to program your mind to only see what supports your view. And that is just dangerous. Remember, at the end of the day, just like with poker, this is all about luck. It really is. Whether your trade works out or not is really a factor, has a huge luck factor for that particular trade. It's a 50-50 chance. So you have to constantly be open for the opposing side. In fact, you need to argue for the opposing side to put on a sizable position. I can't put on a 100-lot trade without making an argument, like a 100-lot trade long, without making a really good argument for a short, but the long was still an exceedingly better argument, so that I can, once I put it on, I'm not having jitters watching $1,250 per tick come in and out and in and out. So certainty is a deal breaker. Just make sure that if you're speaking with certainty, that you check yourself, because if you don't, the market will check you. Take care.